A few weeks ago, the 16th biggest bank in the US collapsed in just 48 hours. How did it happen? And what does it mean for you? I'm Ben with YNAB, and normally I talk about the psychology behind how you manage your money. But today we're doing something a little different. We're going to dig into a major current event and see what we can learn from it. Now, bear in mind, this story does involve profits, but I am not a prophet. So this is not going to be me predicting the future. I'm just going to be trying to explain what happened and lending some perspective. So to start, we have to talk about banks. If I go to my bank and give them $1,000, they don't just toss it in the vault and let it sit there. Money isn't like kombucha. You can't just put it in a dark space and expect it to ferment profits. They're going to take that money and put it into something that will make them money. Some of it will be lent out to people, where customers will pay back with interest. Some of it will be invested into government treasuries, where you basically lend money to the government and get a pretty stable return over time. When you give them your money, it allows them to do this. And this is why they're willing to give you just a squeak of interest to keep your money with them. But I'm going to want my $1,000 back someday, so they can't just throw all of it into investments. That's why banks practice fractional reserve banking. This is where they're required to keep a certain percentage of their money in cash reserves so that depositors like you and me can get it when we need it. Have you ever thought about what would happen if your bank just went out of business? I mean, I didn't really care when, say, Borders shut its doors in my town, because I could buy overpriced books, greatest hits albums, and novelty coffee mugs somewhere else. But my bank has my money. Decades of careful saving on my part could be wiped out by a bank's poor business decisions. Now, imagine that you think your bank is about to go out of business. What would you do? My guess is you'd probably go out and get all of your money before it's gone. And that makes perfect sense. But then your friend sees you doing that and does the exact same thing. And so does her friend. And so on and so on. That's a bank run, where tons of depositors suddenly rush to their bank to get their money out. And that's a big problem for fractional reserve banking because, well, not all the money is there. Banks keep enough to handle the normal rhythm of deposits and withdrawals, but if everyone comes clamoring for their money at once, there's going to be trouble. Why not just sell all the stuff that the bank has invested in? Well, you can't exactly demand the person who just got a mortgage with you to pay the remaining $300,000 today. And if your timing is bad, then cashing out your other investments can lose you money, making it even harder for the bank to stay afloat and making even more people freak out about the bank going out of business. More on that later. So how did this happen to Silicon Valley Bank? And who cares? Well, first, you have to understand that Silicon Valley Bank's primary clients weren't individuals like you and me, but, like the name suggests, tech companies. In fact, by 2023, nearly half of venture-backed tech companies were banking with SVB. What does that mean and why does it matter? Well, a lot of tech startups rely on venture capital to make money. This is where a firm or wealthy individual invests money directly into a company in the hopes of it becoming really successful. It's super risky. Growing a tech company is really expensive, and 3 out of 4 tech startups fail. But if you manage to back the next Apple or Instagram, then the gains could be massive. So a lot of money that companies were putting into SVB actually came from these venture capitalists, people who were taking a big risk in hopes of a big reward. If those people catch wind of something fishy with the bank, they're likely to act quickly and dramatically. Now, the last few years have actually been pretty good for these kinds of projects because interest rates were low, making money pretty cheap to borrow and invest. Not to mention, during 2020, we all became a lot more dependent on digital technology. So SVB got a big surge in business from these tech startups over the last few years, and it decided to take a lot of that money and put it into US Treasuries, a historically safe investment. For perspective, they went from having $27 billion in treasuries at the start of 2020 to having $128 billion in treasuries at the end of 2022. So what's the problem? Well, SVB bought those treasuries at the worst possible time. Without getting into all the technicalities of how these things work, SVB basically bought these investments at their highest price right before they drastically dipped. Now that's a bummer, but it gets worse. Because the tech industry, which again makes up most of SVB's business, has faced a serious downturn. Over 150,000 tech employees have been laid off in 2023 alone, and venture capitalists have been more hesitant to put money into these companies. So these companies have had to lean more on the money they had on hand, meaning more withdrawals from their SVB bank account. In order to keep up with those withdrawals, SVB had to sell a bunch of treasuries at a $1.8 billion loss. Not looking good. Then they announced that they were looking into selling $2.25 billion worth of shares in SVB. So basically, if you give us money, then we'll give you shares in the company. This was supposed to help them get their cash balances where they needed to be so that they could meet withdrawals, and that was supposed to make everyone feel way more confident in SVB. But it had the opposite effect. Remember, these tech companies that bank with SVB depend on venture capitalists, and venture capitalists are well aware that they're in a risky market. If SVB collapsed, these investors would lose billions of dollars, not because the company they invested in failed, but because they simply had their money with the wrong bank. So when SVB shows signs of struggling, a lot of these venture capitalists worry that all the other venture capitalists are going to pull their money out of the bank and cause it to collapse. So naturally, they all try to be the first one to do that. On Thursday, March 9th, depositors withdrew $42 billion from SVB in one day. The next day, the Federal Deposit Insurance Corporation stepped in and took over the bank, effectively shutting it down. Okay, so that's the collapse. Now, should you be worried about it? Do you need to go make some massive change with your money because of this? Probably not. Here's why. During the Great Depression, bank runs were happening everywhere, which prompted the federal government to create the Federal Deposit Insurance Corporation, or FDIC. If your bank has FDIC insurance, which it probably does, then up to $250,000 of your money is insured against a bank failure. If you bank with a credit union, you should have the same kind of coverage through the National Credit Union Administration. What makes SVB such a crazy scenario is that over 85% of funds held in this bank were above that FDIC limit. Remember, these are tech companies playing with buku bucks. You are probably never going to have or need $250,000 just sitting in your checking account. So the odds of you just losing money to a bank failure are pretty dang low. Now, some people are concerned that these bank failures might lead to panic that leads to more bank failures. Besides SVB, Silvergate and Signature Bank have also closed down. But these are all fairly unique situations. Both Silvergate and Signature were pretty involved in the cryptocurrency space and have been affected by the big downturn in that market recently. And SVB, as we said, had a pretty unique clientele of venture capitalists and tech startups who were all dealing with a kind of perfect storm. So the odds that your bank will shut down due to these bank failures is pretty low. Even if it does, you shouldn't have anything to worry about, as long as you're below that $250,000 threshold. And that's it. I know this is pretty different from what I normally do. Maybe you weren't that impacted by this event, or maybe this is the first time you're really hearing of it. But this was a big topic going around over the last few weeks, and I thought it'd be useful to give some perspective. In a couple weeks, I'll be talking about commutes and how much yours is actually costing you. So stick around if you wanna learn about that. But just like Silicon Valley Bank, it's time for this video to come to an end. So as always, thank you so much for watching, and I hope you have a wonderful day.